When it comes to Canadians and their debt, long-term car loans are increasingly where the rubber meets the road. That's the focus for our Debt Nation coverage this morning. Interest rates are expected to rise again tomorrow, and ahead of that, we're taking an in-depth look this week, all this week, in fact, at how Canadians have become the most indebted people on the planet, how they'll manage that burden with increasing interest rates. Some tips for you to avoid that debt trap in just a second. But first, Scott is here taking a look at the issue of long-term loans for cars, how that is becoming increasingly the norm and a major problem, Scott.
Yeah, increasingly becoming how Canadians get more and more into debt, thinking that they're buying an asset when really they're not. I have 4 figures I'd like to share with you as far as how this is compounding Canadians getting more into debt than ever. For example, 55% of all new car purchases in the country are loans that are longer than 84 months. That's a 7-year period. And let me show you how this works. $33,000 is the average car list price in Canada, if you can even find that base price. It's usually a monthly purchase prices. But worst case scenarios, it's about $500 per month loan. If you multiply that by the 7 years, that works out to $42,000. So that's about $9,000 more than the vehicle's worth. Never mind the depreciation on that vehicle, because once you drive a car off a lot, it starts depreciating. Now, the result of all this debt goes after the 7 years that when Canadians go to sell that car, about a third of us owe more in that car than what it's worth in the first place. And this is how we're ending up in this debt spiral, Heather, that people think that they're buying an asset, but in fact, after those 7 years, they owe more on this vehicle than it's worth in a secondary market.
So that is giving us pause this morning. Scott, thank you very much. Time to introduce to you somebody in studio with us now who's going to help you if you're in the market to buy a car and help you make the right decision. Mohamed Bouchama is the head of Car Help Canada. We need your help this morning, Mohamed. How are you today?
Pleasure. How are you? Thank
you so much for coming in. You were listening as Scott was laying out the problem here. More and more, in fact, more than half of Canadians now are taking part in this new trend, which is going with the long-term payment plan, more than 84 months, 7 years or longer. Why has this phenomenon arisen?
Well, after 2008, the financial
the economic
meltdown,
crisis, yes.
You know, I mean, leasing disappeared from the market. As you remember, GM and Chrysler went bankrupt.
Right.
So, and they had the big share of the market as far as leasing is concerned. So when they went bankrupt, leasing stopped. So manufacturers tried to find another way to sell cars.
Okay.
And make it look very cheap, you know, for consumers.
Because it looks like the monthly payment is really manageable, right?
That's all they sell. It's either weekly, bi-weekly, or monthly.
Okay.
You can see now ads, $50 a week. So the consumer say, well, $50 a week, that's cheap. I can't afford it.
So they'll sign on for as long as it takes, and they're getting these long-term deals.
But what they don't understand is if they calculate the total cost of the vehicle, it's going to be huge. It's going to be huge, you know, after 6, 7, 8 years.
Well, that's what Scott was just putting out. It's
Absolutely.
Like $7,000 more they've paid than what the vehicle is worth. And they could be owing money on a vehicle that's worth less at the end of it all.
And there is a term for that, what we call negative equity.
Right.
That's when you decide to trade in the car after 3, 4 years, but you signed for 7 years, all right? And then suddenly the car is worth 30% less. What's worse is a lot of people trade in their cars and they finance a new car. So what the dealer does is roll in the old debt into the new debt.
And then you're stuck with this humongous amount. We met a young woman earlier this morning, 20 years old, more than $50,000 because her initial car was a lemon and she had to roll things into a new car. So she's been paying for years and it's been very onerous for her.
And the car is worth $22,000.
Exactly. Okay, so to the rescue, the help that I promised. Here are Mohamed's lists of do's and don'ts. And let's expand on these. We'll put them up between us and then we'll talk about this. Something that you do recommend, figure out what you can afford. What do you mean by that?
Absolutely. What I mean is find out what your budget is. Don't go over your budget, because a lot of times you go to the dealership, right, and you intend to buy a certain car. Then suddenly you start seeing other cars at the dealership, and the salesperson is eager to upsell you.
Okay.
So make sure you stick to your budget.
And do you want to go right to the max of your budget, or, I mean, because
No,
if rates go up,
you
leave
got to
yourself
leave
some...
something because you
Okay.
got to pay insurance, maintenance, so you got to be very careful. So don't let the salesperson upsell you. It's very, very important that you stick to your budget.
Okay, that is a tough thing to do. So part of the other plan is to consider your changes in car needs. Not only do you need to figure out what your budget is, you need to figure out what kind of vehicle you need, right?
Absolutely. I mean, we see this at our office every day, is people go to a dealership and suddenly, you know, they go to, for example, to buy a Toyota Corolla for a $22,000 car, right? Suddenly the salesperson would try to sell them a Camry or a RAV4. Oh, this is an SUV, it's an all-wheel drive, it helps you during winter. But what they don't tell them is it's going to cost them another $10,000.
So it's all together. Figure out what your needs are, figure out what your budget is. Don't go for those.
Absolutely.
And then here's the couple of don'ts, and I think we've kind of touched on these,
Yeah.
but let's summarize them again. Don't finance a car for 6 or 7 years. What do you think is the max?
Max should be 5 years.
Max 5 years.
I mean, remember, in the 60s, banks lend money for car purchases for 3 years. That was the maximum in the 60s.
And now we've more than doubled that.
Exactly.
No more than 5. And of course, as you've said already, don't let people upsell you, dictate to you. Have your needs, have your budget, stick to it.
Well, the other problem, and I would like to mention this, is in Ontario, we don't have a cooling off period. So even if you make a mistake, you can't go back next day and
No
say, well, I
buyer's
want...
remorse.
No, once
You
you
are
sign,
stuck.
it's your car.
Okay. Thank you so much for coming in. A pleasure
You're
to help.
welcome.
And you did indeed offer us Car Help Canada. Mohamed Bouchama with me here in studio.